A few microseconds are far quicker than the blink of an eye. That's how long it takes for a share to trade these days. But bewildering speed is not the only thing that technology has changed about stock trading. Hello and welcome to Inside Exchange, and on this episode of the show, we'll talk about the evolution of stock markets in India and how technology has changed the way we buy and sell stocks forever. Joining us on the show, three authorities on the subject. So we have Ajay Bagga, Executive Chairman of OPC Asset Solutions. Joining us also Dipan Mehta, Founder Director at Elixir Equities. He's also a member of the Bombay Stock Exchange and the National Stock Exchange. And Yagnesh Parekh, who is the CTO of ICICI Securities. Gentlemen, thanks so much for joining us here in our Bombay studios. Mr. Mehta, I want to begin with you. You know, many still think of share trading as this sort of activity that takes place on the floor of a raucous stock exchange, you know, with images of traders punching orders and frenzied shouting as the markets gyrate. That was once the picture, wasn't it?
Yeah, absolutely. Those are different times. And of course, I think not many of that generation still are around also, I would say. Markets have moved on, traders have moved on, and now I think it's all online. And even the visual images which come in the media is all about the screens which are there of the various stock exchanges for online trading. So I think that particular era is over and done with. And this is now the age of not only online trading, but high frequency trading, algo-based trading. And these are the new kind of technology which have come into the stock market business and on the brokers end as well.
Right. Mr. Parekh, you know, stock trading has happened in India right since the 1800s. I mean, there's famous stories about how a group of 22 traders sat under a banyan tree in Hanuman Circle and began the first, spate of trading. But the most decisive period in some sense came in the 1990s, and there was a robust development of the markets then. So just give us a sense of the history and the evolution.
Yeah. Earlier the system where it was a manual driven, where it is known as an outcry system, where people go and shout and decide it, how the trading has happened. And then since 1992, when the electronic stock exchanges started in India, since then adoption of technology has picked up at a very fast pace. Initially that stock exchanges started screen-based trading, moving away from the outcry system to the screen-based trading through a connected via VSET of the Pan India. Right. So the stock exchanges moved from a centralized place at Bombay or place to the Pan India, where through the screen trading anybody can anywhere can trade. Right. Since then the adoption of technology has gone up again. In 95-96 the dematerialization has been introduced. Right. And physical shares has moved to the electronic shares. Right. So completely electronic shares has been started issuing that. Then the settlement was also earlier happening in 5 days time. Now that has moved to 2 days time. Right. With the adoption of the technology that is also has adopted. And in 2000 the big change has happened where pioneers like ICICIdirect.com and ICICI Securities has come up with online trading where the customer can trade from their home. Right. No need to depend on any other broker or any other agent or anybody. Right. So that has brought a transparency also and integrity of the system in the stock exchanges.
Absolutely. Mr. Bagga, I want to ask you to help us understand how this sort of screen-based trading works, where anything can happen from anywhere in the country, buy-sell orders are matched automatically. Give us a sense of how it all works.
See, earlier you would place the order and there was a lot of spread. You were not sure at what rate your broker actually did the transaction, what was recorded in the stock exchange, and you would wait for the contract note. Now everything is virtually instantaneous. There is an order matching system. So the back-end system at the exchange is aggregating from all brokers' terminals around in milliseconds. All the buy and sell orders by securities are flowing in, and these are matched automatically and squared off. So you can give very sophisticated orders, or you can place a market order. Market order is basically just buy or sell at the prevailing rate at that instant. Or you can give levels, you can put stop losses, you can put other kinds of trailing stop losses to protect your profits.
Right.
So overall, what has happened is there's a democratization. The asymmetric information, where the market participant had a bigger information than the customer, has gone to a large extent. And what the exchanges are doing very well, along with the regulator, you get independent verification of your balances. I'll give you a small example. Earlier, the shares were in demat, were in physical form. And people knew they would hold the shares of NRI relatives and clients. They knew with the wrong signature, the shares will come back. They would sell it in the market, knowing fully well that this will not be honored by the RNT agent. And a lot of gangs used to run who used to, poach out these shares from the mail and transfer them to their own names.
So the intervention of technology, as Mr. Bagga is saying, has in some sense helped in mitigating fraud and the various associated risks. Mr. Mehta?
Yeah, absolutely. I think, and those have been the defining moments of the capital market. Because as of now, I think our systems are amongst the best in the world. And it has brought a lot of confidence into the capital markets. And see, we are reaping the benefits of that. I think it took a while for investors to, get acquainted and get the confidence in the new settlement systems, the new trading systems, the various new structures, be it mutual funds or alternative investment funds. But now I think if you see over the past 4 or 5 years or so, clearly capital market savings, or rather putting savings into stock market, is becoming more and more mainstream.
Let's try and quantify that a bit. What's been the impact, so to speak, of this technological shift in terms of the volumes traded, for instance, or the retail and FII participation going on? I know you may not have, the exact numbers, but how have the market sort of become bigger as a result of this?
I think there's been exponential increase in the volumes of the market, not just the cash markets, but a lot of the volumes are in the derivatives market, that's futures and options, which were not there earlier. So a lot of volumes are getting created over there. And it's, participation is there from across the globe, right from US to Japan, easily traded over there. And, it's been a huge, massive shift in terms of the number of participants, the quality of the participants, the trade size, and there are so many various books within these exchanges as well, which all get active from point to point. So all this has helped to even deepen the liquidity of the market. And liquidity is a very important factor, yes.
As much more money that's come into the market.
More money and more stock is available. So, you can do a large trade at a single price. So the impact cost has reduced significantly.
Right.
And, these things are kind of a virtuous circle. Because there's liquidity, it attracts many larger players. Because larger players come, there's more liquidity. So what we have seen in the stock market because of technology is like kind of a virtuous circle where more and more players are coming in, therefore more and more sophisticated systems are being put in place. And that's attracting even more players. And then now the smaller investors also are coming in. So it's been like, the absolute success story of, I think, India, I would say, was the capital market.
The evolution of the stock markets. Okay. Mr. Parekh, I want you to elaborate a little bit more about the point you made on how technology has democratized markets and the reach of the investors improved. I mean, earlier, I'm presuming you wanted to buy something from an exchange, you would have to physically go somewhere. Today, things are quite different, aren't they?
Yeah, earlier, see, in the remote places, people have to call up to their broker or agent or on a phone. They will give a price to agent. He will give a price to some broker sitting in the exchange in Bombay, who will go into the ring, do some trading. By the time the price changes, and there was no transparency.
Right.
Actually, the customer don't get a clear picture on what price it got executed, traded, or no idea. Coming to the era of screen-based trading to online trading, now customer can see on the screen the price which is going on the exchange. Okay, what price he will get, he can decide his price at which he want to execute as explained in the market order or a limit order. So the customer got more awareness about and transparency on what exactly price is going to get, what is the profit and loss is going to gain. Okay, what is the risk he is carrying, if at all. That is so. The technology has brought all these things, and now the customer can trade anywhere pan India. Even he is traveling abroad, he can do the trading.
Yeah.
In the latest trend, if you look at it, the people can do a trading through mobile also. Mobile trading has become extremely popular. About more than 20-30% of the volume is nowadays happening via mobile in the retail business. And you can just on the move travel either in a train or bus or traveling anywhere else, you can still place the trade and do that.
Right.
So that's all because of the evolution and adoption of the technology.
Right, so transparency, that's been the big pain point that's been addressed, and also the marketplace presumably has become a less opaque and secretive one. But Mr. Bagga, has electronic trading helped bring costs down, both for the companies listing and also for the investor?
Tremendously, tremendously. I'll give you a couple of examples. Goldman Sachs recently at Harvard, there was a symposium on the role of technology in stock markets, and they came out with a very interesting picture that they used to have 600 traders who used to do equity trading. They have been replaced with 2 traders left and 300 software programmers, computer programmers. So now the ratio in the industry is virtually 4 traders can be replaced with 1 software programmer. But they have kept nearly 1:2. There are 9,000 computer programmers working in Goldman Sachs, which is like 1/4 of their total employee base. And another interesting thing, their CTO spoke in that seminar, that for fundraising for a company, say a company doing an IPO or a follow-on offering, they realized there were 149 steps involved. And they have automated a number of those steps to crunch that time and that cost. So technology has reduced costs. Now you have brokers who are offering trades. In the cash segment, they're offering at 0 brokerage. And in the futures trade, they're offering at 20 rupees per trade.
All right, hold your thoughts because we'll have to slip into a break. When we come back, we'll talk about the future and where we go from here. We'll also get you started on how simple it is to trade in the markets with an easy demat account. Stay with us.